This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Kyle Hyatt, and this is the Portfolio Pulse fourth quarter update for the Hennessy Focus Fund. Joining me today for this episode is Ira Rothberg. Ira is the co-portfolio manager of the Hennessy Focus Funds. Ira, welcome. Let's get right into the questions today.
Terrific. A pleasure to speak with you, Kyle.
So you've been working on the Hennessy Focus Fund for nearly 20 years. What has changed during your tenure on the fund?
I would say that much more has stayed the same than has changed over the last 2 decades. Today, we employ the same investment approach that we have for the last 2 decades. We're looking to invest in a special class of businesses that we call compounders. These are competitively advantaged businesses with excellent management teams and long growth runways, and we think that they can provide outsized returns for a decade or longer. We think our fundamental research, our long-term orientation, and portfolio concentration give us a competitive advantage in a crowded investment manager market. We're always trying to get a little bit better every day, and so I would say that what's changed over my tenure on the fund has been that we've made small tweaks to the research process that make us a little bit more efficient, allow us to comb through more investment opportunities on an annual basis. These changes include adding additional analysts to the team and making greater use of expert networks so that we have to do less of our scuttlebutt research and outreach to customers and former employees and competitors on our own, and we can have other people set up those types of calls. So, I think the value is that we're able to analyze about 100 new opportunities each year. And with our portfolio concentration, we only typically add 2 or 3 names a year. So we can be really selective and patient in finding the right ideas for the portfolio.
Great. Thank you, Ira. Next question. How do you identify secular growth businesses that, they have the potential to produce a sustained mid-teens or even a higher rate of earnings growth?
As a team, we've researched thousands of businesses over the years, and we study, as I mentioned, over 100 businesses each year in our search for compounders. We think these compounders, as we call them, have common characteristics, and we use our 5 investment criteria as a searchlight as we attempt to identify these compounders. Those characteristics include a competitively advantaged business model that provides the business with an economic moat, something that makes it hard for competitors to replicate the special advantage of the business. We're looking for companies that have an excellent management team and a long growth runway. And then we want those first 3 characteristics at a reasonable valuation. So, after doing this for more than 2 decades, studying thousands of businesses, you start to recognize patterns across industries and business models, and you're better able to distinguish the good management teams from the great. I think one tool that we've found helpful over the years is just study the businesses with terrific financial track records, ask ourselves, why did that financial success occur, and is it likely to continue in the future? And so, we have a stable of about 75 names on our watch list where we're hoping that they become available at a more compelling price, and we can add them to the fund.
Great. That makes sense. Thank you. So, Ira, let's talk a little bit about the Fed now. They are aiming for a 2% inflation target. Do you think that's reasonable? And if so, how does it impact your investment decision making?
I think the 2% target is reasonable. The Federal Reserve has made tremendous progress towards that 2% goal. I think just yesterday, Jay Powell observed that we've had 6 good months of inflation data. The Fed certainly needs to be sure that they've broken the back of inflation before easing, but we think that the Fed will begin an easing cycle by mid-year. We think spending on many big ticket items like housing, building products, furniture, and used cars have fallen below normalized levels and are set to rebound as interest rates decline. And so we think the portfolio is well positioned for the evolution of interest rates from here. We also have a number of portfolio companies that have significant real estate ownership, and we think that they're also set to benefit as cap rates decline and the cost of financing improves.
Thank you. Let's talk about index funds now. So there's a lot of well-known investors that say, people should only invest in index funds. Maybe you could explain about the decision to maintain a, more of a highly concentrated portfolio of approximately 20 exceptional investment ideas.
So the academic data suggests that 90% plus of active managers underperform their benchmark over the long term. So that advice that many provide about index funds is partly correct. There's also academic studies that suggest that since 1926, only the best performing 4% of stocks have provided all the wealth creation in the stock market above the return of treasury bills. So the cumulative total return is concentrated in just a few high performing companies. And so the question that we ask ourselves is, how do we give ourselves the best and highest probability of identifying those exceptional companies? And we think that our portfolio concentration, owning about 25 names, only our low turnover, only adding 2 or 3 new names to the portfolio each year, allows us to be selective and patient in trying to identify those exceptional companies, those compounders that can allow us to beat the market over time.
Great, thank you. Next topic, AI. It's all the rage out there, right? So maybe talk about how your team uses AI as part of the investment process, if at all.
We don't use AI directly, but what we have observed is that a number of our software vendors are building AI into the software products that we subscribe to, whether it's expert network databases, whether it's transcript services, whether it's financial data providers. They're increasingly finding trends or keywords that are mentioned often, or trying to judge sentiment using AI. So I wouldn't say it's a big part of our investment process, but it's certainly a developing space.
Great. So let's talk a little bit about the Focus Fund now. Specifically in the fourth quarter, which stocks drove performance?
Our biggest contributors were companies with direct or indirect exposure to real estate and or housing. American Tower, Brookfield Corporation, and American Woodmark were among our top contributors. It's no surprise that these types of names outperformed, considering that the 10-year Treasury yield declined from a high of 5% in the quarter to about 3.9% to end the quarter. And names with housing or real estate exposure are highly sensitive to rates because there's significant financial leverage employed in both housing and in commercial real estate. One name I mentioned, American Tower, is one of the largest owners of cell phone tower sites around the globe, and they employ meaningful financial leverage because of the consistency of their cash flow. And so their ability to refinance their debt at lower rates is made possible if we see a change in the shape of the yield curve and decline in long-term rates.
Great. Looking again at the fund, your largest sectors are financials and consumer discretionary. So 2 questions here, but why financials? Why is it the largest in your portfolio? And then the second is around just you're giving us your thoughts around consumer discretion for 2024 here.
Sure. Financials compose about 30% of the portfolio. We're not looking to mirror a benchmark weighting. We build the portfolio from the bottom up. When you say financials, most people think of traditional depository institutions. Our businesses, in fact, do not include banks. Among our financials are Aon, a global insurance broker, Brookfield, an investment manager, Markel, a specialty insurer, Encore Capital Group, a debt collector. These are businesses that are highly differentiated from each other in terms of their business model, in terms of their growth drivers, and they're not exposed to the same asset liability duration mismatch as the banking industry. They have differing sensitivities to the credit cycle and capital markets, And we think there's a strong investment case for each company. Maybe I'll talk briefly about Encore Capital Group. Encore is the largest buyer of charged off credit card paper in the United States. Credit card debt outstanding is at all-time levels. Delinquencies are building. The amount of charged off credit card paper available for purchase is growing. Encore has an advantaged collections methodology where they can generate more cash collections than their peers. And the stock is available at a very low multiple on trough earnings. And we think that they're well positioned for a strong cyclical rebound. Moving on to consumer discretionary, in 2023, consumers were surprisingly resilient in the face of high inflation, rising interest rates, and increased recession risk. We think that 2024 sets up well for consumer discretionary names because we expect wage growth to remain strong, disinflation to continue, and the consumer balance sheet, while not in as great a shape as 2023, is not distressed across the board. And we very much believe in a K-shaped economic recovery where the top 1% of earners, top 10% of earners are doing very well with the appreciation in the stock market. Folks at the lower end of the wage spectrum are really struggling with the 20% or so cumulative inflation we've had since early 2020. And so one name that we think benefits from the pressures on lower income earners is O'Reilly Automotive. O'Reilly is one of the largest distributors and retailers of aftermarket auto parts in the United States. And people are really in a position where, because used car prices are so high, interest rate on used car or new car loans are high, that they really want to hold on to their existing vehicle. And they're willing to invest more in the maintenance of their vehicle, the upkeep of their vehicle, than they really have ever before. And O'Reilly has been taking market share in this industry for decades because of a competitively advantaged business model, a distribution network that allows them to have a better fill rate and speed of delivery to their stores for both do-it-yourselfers and the professional mechanic. So we think that O'Reilly's going to continue with the success it's had for many decades and is still available at just a slight premium to a market multiple.
Great, thank you. Let's talk about another company you added in Q4 here, Altus Group. What's the investment case there for Altus?
Sure. Altus is a provider of services and software to the commercial real estate industry. And what I'd say is that, we've long been attracted to vertical market software companies, to information service providers. And Altus really has a monopolistic position in the modeling and valuation space for CRE, for commercial real estate. And their tool, which is essentially an enhanced Excel and an enhanced discounted cash flow model with lots of inputs specific to this industry, has become the currency among buyers, sellers, brokers, lenders to the commercial real estate industry. It's almost like trying to pass an uncommon file format back between different parties in a marketplace. It's helpful to have a standard file format. And so they've transitioned their software business to the cloud. One of the benefits of having their software businesses in the cloud is that they have 1 million plus properties modeled. And what they can increasingly do is take anonymized data from those 1 million plus models and sell it to their customers, to their clients, allowing them to benchmark against other properties, against other investment managers, but also provide predictive analytics to their clients that will allow their clients to generate additional alpha. So, we think this is a business that can compound its earnings per share for us at a mid-teens to high teens clip for over a decade. And we're buying it essentially at a market multiple, which is uncommon for vertical market software companies.
Great, thank you. So Ira, last question here, 2024, what's the outlook for the market and specifically the Hennessy Focus Fund?
Well, we're we're long-term investors, and so we try not to forecast the market over a 1-year horizon because we think it's an impossible task to do on a consistent basis. We feel more comfortable providing an outlook for the next 5 years. And because our funds holdings are predominantly a collection of what we believe to be high quality secular growth businesses trading at a reasonable valuation, we think that our portfolio's returns over the next 5 years are going to be driven by the underlying earnings growth at our portfolio companies. And so because we have conviction in the prospects for these businesses, we feel very good about the outlook for the fund over the next 5 years. If I was forced to guess about what happens on a 1-year horizon, I would say that we do not expect a recession in the United States. We think that economic growth can actually improve over the course of the year as monetary policy is loosened. We expect strong fiscal policy stimulus with about a 7% budget deficit this year and continued disinflation. The job market's strong, wage growth is still strong, and consumers will have more money in their pockets as disinflation continues. We also forecast a strong rebound in a lot of the cyclical interest rate sensitive categories of consumer spending and business fixed investment. So we think 2024 is setting up to be a good year.
Perfect. Well, Ira, thanks so much for coming on Viewpoints by Hennessy. I just encourage our viewers, to learn more about the Hennessy Focus Funds. Please visit hennessyfunds.com.